The last thing we did was stretch. And the idea with stretch was people said, yeah, I'd like to get 10% bank account instead of 5%, but I don't want the volatility. I don't want to think that maybe the principal would trade up $10 or trade down $10 a share. Like if I buy it and it's trading at 110 and then the interest rates change and it trades to 105, I'll have lost 1 year worth of interest or 1 year worth of dividends. So we wanted to find some way to get to $100 and keep this price right around par, right around 100, lowest volatility imaginable, and extract the yield. Okay, and so the idea of stretch is we don't want duration risk. What Strife has is long duration. That means effectively 120 months of interest duration. That will cause the principal to move up and down, but below or above par a lot. In fact, 1% move in interest might cause a 20% change in principal if you have a 20-year asset, right? So what we wanted to do was strip all the duration off. So not 120 months, we go to 1 month. And when you strip the duration off, you strip the volatility off because the 30-year bond trades much more volatile than the 1 month treasury bill. So we wanted to strip the volatility off when we stripped the duration off. To do that, we had to create a monthly instrument, not quarterly. So we basically took the dividend to a monthly cash pay, and then we had to create a variable dividend rate. So this is the first time in modern capital markets that a company created a preferred stock that has a variable monthly dividend. And so we call that a treasury preferred. We invented the treasury preferred stock with AI. I used AI to do it. Yeah. Nobody else would have thought to do it because they never had an asset that would justify doing this. In essence, stretch becomes like, it's not quite a high yield bank account because you don't have perfect zero volatility. You know, if you had a $1,082.32, you would get exactly $1,082.32 tomorrow if you asked for it. It's not that, but you would be pretty close, and you could put money in it that you needed to hold for a year with very low volatility. You could collect the 10% dividend. And then if you needed the capital back, you could redeem it into the market and get your capital back. So the idea is a Bitcoin-backed money market type instrument, not quite as good as a money market. They're less volatile, but we wanted to compete with that, you know, with Bitcoin backing it.